Thank you to everyone for joining us today. My name is Marcia Zappa, and I am the Director of Marketing and Business Development at Affiance Financial. I'll be moderating today's call. I want to start out by clarifying that this is a call, audio only, no presentation. So if you are joining by phone, you aren't missing anything. Due to the number of people on this call, all participants have been muted. If you have questions and are joining by computer, please use Zoom's Q&A function. I will be monitoring it during the discussion and will do my best to facilitate live answers to your questions. If we are unable to answer your questions during the call, we will follow up to the best of our ability, but please don't hesitate to reach out to your advisor. Today we have Principal and Financial Planner Andy Fishman, Principal and Financial Planner Steve Lear, Principal and Chief Investment Officer Seth Meisler, and Director of Trading and Co-Chair of the Investment Committee, Marc Usem. Andy, will you please start us off?
Yes, Marcia, thank you. And Marcia, thank you for coordinating these weekly calls. We appreciate the assistance. I want to just start off by, again, wishing all families health and well-being. It's important to us to know that everyone is healthy, and in these critical times, it's probably the most important piece. Many of you have heard from me on markets and market commentary, and we're gonna get more of that today from Seth and Marc. And I just wanted to take a little bit of a different angle and talk to everybody about silver linings. And I'll pertain it to myself, but I'm sure some of this will resonate with everybody. But we've had a chance the silver linings, and we've had a chance to have many more sit-down dinners. My kids are home from college, and so it's been a wonderful time to sit down and have dinners. We've had a chance to clean our office. This was a time where we have time on our hands. We've walked the dog. We have watched movies as a family, and I have had a chance to watch some movies by myself. We have walked the dog, and over the weekend got a little bit more sleep. So I know that during these times it's challenging and we're in uncharted waters, but there can be some silver linings. And I know many of you would have your own extracurricular and hobbies that you're getting a chance to work on. I wanted to start by, this call is going to be a little bit different than the last two. After Seth updates us on what we need to know, we're going to hear from Marc Usem, as Marcia said, our Director of Trading and Co-Chair of our Investment Committee. Marc will be sharing some of his experiences working as a financial professional during some other market dislocations. Marc had a chance to share his stories with our investment committee and our team, and we thought it would be beneficial for everyone else to hear those as well. We will still reserve some time at the end for questions, and Marc's story is on the blog if people want to read it or hear it at a later date. Seth, will you now take us through some of the market narrative, what we know, and some of the updates?
Sure. Thank you very much, Andy. Before I start, I do need to start with an important disclosure. Please remember that with investing, there can be no assurance that the content made reference to directly or indirectly in this conference call will be profitable or suitable for your individual situation or prove successful. Due to various factors, including changing conditions, the content is only reflective of current opinions or positions and is subject to change at any time and without notice. Moreover, you should not assume that this call serves as a substitute for personalized investment advice from Affiance Financial. Please remember to contact Affiance Financial if there are any changes in your personal financial situation or investment objectives. So with that compliance requirement completed, we'll move forward. While it's only been a week since we last talked, it definitely feels like a lifetime. On a personal note, I want to thank all the people who I've spoken to who have universally been concerned about me and my family, and I can assure everyone that we are all fine. In addition, over last week, in addition to talking to clients, we've been very busy talking to a variety of mutual funds, whether they're external managers, the mutual fund managers, economists, doctors, columnists, etc., regarding what's happening, what they're seeing, putting things in perspective, and we'll bring you those insights. One other thing that's pretty important that happened last week that I want to share is that Treasury Secretary Steven Mnuchin announced the tax filing deadline for the 2019 federal income tax returns will be extended from April 15th to July 15th. The extension of the tax filing deadline also postpones the deadline for making 2019 prior year contributions to traditional and Roth IRAs from April 15th to July 15th. Normally, IRA contributions for the prior year are not permitted after April 15th, even if an individual files an extension. It'll be really important for people who make contributions after April 15th to coordinate those contributions with their advisor, and that we can do so with TD Ameritrade to make sure that they go into the right year. While most of us are looking at the stock market, I'd say really the current epicenter of the market dislocation over the last couple of weeks has been really in what I call bond land. And what we're seeing has been massive dislocations in credit, primarily caused by a rush of corporations and potentially hedge funds to get cash in order to tide things over. This includes selling assets indiscriminately, getting commercial paper, and drawing on credit lines. Keep in mind that the process when companies draw on credit lines, banks are required to sell treasury bonds to create that cash. And the problem that we're seeing is that there are no buyers of those treasury bonds. As a result, spreads have widened across the board because of the current supply-demand imbalance. The Federal Reserve has stepped in and has dusted off many of the tools that they developed in 2009 so that the current situation does not become a financial crisis like it was in 2009. Steps that they've taken have included both opening a primary and secondary corporate credit facility, granting access to small bank loans, providing support for mutual fund money markets, and most recently, allowing the purchase of ETFs. In a nutshell, basically the Federal Reserve has brought their entire army to do what they can to support markets. We're also seeing over this week fiscal policy step up with Congress looking ready to pass a bailout package. It's currently too early to comment on any of those details at this time. However, it's important to note that the markets are reacting extremely positively to this news. While I think the majority of the drop is behind us, I would say we are certainly not out of the woods. I've always said in the past that the market does not like uncertainty, and there is still significant uncertainty ahead of us. Issues that we still see ahead of us include the growth of cases of patients infected with coronavirus is going to accelerate at a dramatic pace, primarily because of two things. One is that people were still socializing with each other about a week ago or so, so the social distancing has only happened literally in a week, so more cases are going to be presenting themselves. And secondarily, because there's been a lack of tests and speed at which those test results are received. So we have both a service and a data problem when it comes to testing. As that improves, which I'm sure it will, the numbers of infected will naturally go up. In addition, other areas of uncertainty include that corporate bonds have yet to be re-rated. We've had in the last day or two about 100 re-ratings from S&P on corporate bonds. And so there's a lot of questions whether is an A bond still an A bond, and what does that mean for the market? That could create a further sell-off in bonds as those bonds get re-rated. Companies are also now indicating that they're not going to be giving second quarter guidance due to the uncertain economic situation and the raising levels of uncertainty. We do expect that there's going to be winners and losers in the current environment, and it would not be surprising to us to see a household company declare bankruptcy, which we think will also lead to a level of uncertainty and potentially fear. And of course, we don't know if the current shutdown is going to be weeks or months. Our current thoughts on the market is that it will likely flatten once the sellers have exhausted themselves, and that there could even be some positive momentum in the market in the short run, as we're seeing in fact today. That being said, our expectation is that there is going to be a second leg of this drawdown, and that second leg will happen once we start getting data from corporations as well as just general economic data. It's also an interesting data point that I think is worth sharing is 2 weeks ago, or the week before last, we looked at who was buying and who was selling S&P 500 ETFs. And what we saw is that predominantly the sellers of the S&P 500 ETFs were institutional sellers, and the buyers of the S&P 500 ETFs were advisors and individual investors. And I think that's an important point to differentiate, because I think it's an issue of time horizon. Your time horizon is really measured in years and decades when looking at buying the S&P 500, whereas institutions are really looking at weeks and months for their time horizon. So really different market reactions from the different participants. That being said, looking at the market and looking at valuations, we do think that they are getting more and more attractive, and that it's an exciting time to be an investor. The Affiance Investment Committee continues to meet regularly to monitor and address this situation as warranted. As of now, we are committed to our firm's disciplined investment strategy, and we are committed to addressing each of your needs individually based on your unique situation. So if your situation has changed in any way because of the current economic climate, et cetera, please have that discussion with your advisor. So with that being said, I will turn it over to Marc to share his insights.
Thanks, Seth. Thanks for those comments. I thought maybe switching gears a little bit here, I thought that looking back at history a bit and market dislocations, economic shocks that have occurred during a greater part of my lifetime might provide some guidance for what lies ahead. And so I did sort of transmit this message to our investment committee, and everybody thought, well, let's transmit it more widely. So let me do that briefly here. So I was an internet industry analyst prior to the 2001 dot-com crash. I was very familiar with what was going on in the industry, the weaknesses in the tech sector, buildup of phantom companies, crazy valuations, and I was asked to finance really companies that were not viable, and I didn't do that. I left the industry, and the subsequent fallout was dramatic, to say the least. To flush out all the excesses that took place during that period, the overexuberance, massive wealth destruction took place, particularly in the tech sector, as many of these companies were really just shells. And that was the bad news. Of course, it hurt many of the other companies along with it, but it laid the base for the next long leg higher for stocks, and diversified portfolios recovered. Now, those that were just focused on tech maybe didn't, but certainly diversified portfolios recovered nicely. That was one difficult situation. Then I stood at the base of the World Trade Center on 9/11 in 2001 when it was hit by a passenger jet, and the financial and human risks at that point were absolutely unknown. It was life-changing for sure for many of us, particularly those that were there or that lived there, but the government reacted pretty quickly, and the overall economic impact dissipated before too long. Now, for most people, life returned to normal within just a few short months, but for others it didn't, but it took a while to get back on track. Of course, it was a devastating event, but it also laid the groundwork for better days and reinvestment. Diversified portfolios recovered. That was a scary time when even the stock market shut down for a period of days there. I was a hedge fund manager for a period of time. I was on the dark side for a period of time. And back in 2008, during the financial crisis, we had intimate knowledge, I guess, to some extent, of what was actually happening inside the markets with respect to credit, and in particular, the mortgage market. I understood the imbalances and risks very well, which were severe, and the leverage that was taking place at that time. And we saw an entire industry, specifically parts of the banking and hedge fund industries, collapse in just a few short weeks as credit markets seized. Billions evaporated. Everybody probably has some sense of what happened during that time, but the financial excesses were exposed. Our country really barely avoided the worst outcomes due to the hard work of central bankers. The central bankers, not just in the US, but across the globe, coordinated efforts to bring some stability. It could have been worse, but it did work out. It turned around. The financial excesses were reset. Expectations were lowered, and the base was created again for the next decade of expansion. Diversified portfolios, again, recovered. It took some time, but they recovered. So today, we have had a decade of powerful stock market gains, but we face a new crisis with new and different challenges. It's not the same always. It's always a different story, but the outcomes are a little bit, I think, better this time in that I think we have a little bit better of the calculus of what we're dealing with, whereas before we really had no idea. And while we don't know perhaps the length and depth of what we face, we do think there's light on the other side of this pandemic. There will be remedies, there will be some antivirals, there will be some vaccines. It may not be perfect, but we will get through this. And clearly terrifying in the midst of it, it will pass. The world will not end. Valuations will be reset, and it will set the stage for the next move higher. There will be significant pent-up demand on the other side of this that will be unleashed, and diversified portfolios, again, will recover. They will recover. So how to prepare for the storm? It's very scary in the midst of it, and it depends on everybody's unique financial situation. For those people withdrawing cash, we recommend work with your advisor. Make sure you have enough cash set aside. If you're in savings mode, keep investing if you can. You're buying stocks on sale. Nobody likes to buy stocks on sale for some reason, but they like to go to the store and buy other things on sale. But stocks on sale are great, and so it does provide an opportunity to buy low. If you're lucky enough to have extra money you don't need, consider buying the dip. And if not, reconsider stressing your financial plan this year. Scale back a bit if necessary. Scale back a bit if necessary. Focus on your family needs and try to reduce stress. We know each person's situation is unique, and we are here to help. If you have questions, if you have concerns, even if we don't have all the answers, please reach out and give us a call.
Thank you.
Over to you, Steve.
Thank you so much, Mark. I get to summarize this, and I'd like to state first to Andy, Seth, and Mark. Andy, thank you so much for telling us about how you walked your dog at least twice. But Seth and Mark particularly, I think you gave just a very realistic view of what's going on and what might happen. And I can't thank you enough for just peeling back the onion and kind of explaining exactly what we think is going on. One of the wonderful things about Affiance Financial, as somebody who has now been 40 years, and this is my 6th meltdown, is my confidence level of getting through this is far greater than it has been in the past because of the people involved in Affiance. You have people who count on the past and historical information. You have people who are just focused on what's going on today. And then you have some people who are focused more on the future. And that combination, I think, does a wonderful job to the clients on being able to provide perspective. And so I just wanted to bring that out to the three of you and the rest of the crew of Affiance. I do want you to know there's so much noise and so many distractions that are going on, but my pleasure and I'm so thrilled with what is happening within Affiance and being there, being able to support you, and being available. The other positive thing, this is going to be hard, but I can't wait to the other side. The other side is going to be so, I think it's going to be absolutely remarkable. And I just don't know when it is. I don't know if it's 6 months, 3 months, and none of us do, but I definitely want to be there to see the other side of us getting through this. Again, thanking planners, advisors, staff, and the last people that I want to thank is our clients. We have made hundreds of phone calls in this past week, and you guys are so special because many of you are asking, how are you doing? As Seth said earlier, how's the company? Are you hanging in there? We're hanging in there. We're hanging in there, and we'll be there for you. We'll be there to answer the questions. Do we know all the answers? No, we don't. But we will be there because we want to see the other side of this. Thank you all for being who you are and for your trust in us. Marcia, I'll let you take it over so you can wrap this up and we can get into the questions.
All right, thanks, Steve. That sounds good. Seth, we do have a question here. Has Minnesota's state tax filing deadline been adjusted?
Yeah, so on Monday afternoon, so yesterday, believe it or not, Governor Tim Walz did sign new executive orders, and the state individual tax filing deadline is now July 15th, 2020. So that is in line with the IRS. However, there is an exception, and that is that does not include estimated tax payments for individual income taxes due April 15th, 2020 for the 2020 tax year. The estimated income taxes are still due on April 15th.
Okay. Mark, would you be able to give a brief explanation as to what an ETF is?
ETF is an acronym that stands for an exchange traded fund. So essentially it's a mutual fund, but it trades like a stock during the day. So you can trade it at any time, whereas a mutual fund only gets processed, traded, if you will, at the end of each day. So it is a group of holdings, stocks or bonds, just like a mutual fund, where the main difference is that it's a liquid security traded in real time.
Okay, thank you. Seth, with the U.S. government considering a $1 trillion stimulus package effectively funded by debt, what are implications for inflation and longer-term bond yields?
So our opinion right now is that yields are going to be low and are going to remain low for quite a while. And that's primarily a function of demand as well. So today, we're more concerned with, I would say, deflation than inflation. And so it's going to be quite a while for low interest rates. At some point in time, do we think that there could be inflation? Yeah, but I think it's going to be years and years away. We have definitely been on the lower for longer camp for years, and that has proved to be the case. And we still think that a lot of those issues have not gone away.
Okay, we've got, oh, we might have a few more. The next one here, Mark, perhaps you might be able to speak to this. Any guidance on the housing market, both on buyer and seller side? Not really sure, but if you have any input.
Well, I'm not sure exactly what part of the housing market. I assume we're talking about residential real estate, and the buyer and seller market has clearly dried up, meaning transaction volumes have stopped to some extent as people try to assess what's going on. I expect that there will be weakness in the residential housing market, mostly due to employment situations that are fluid. And so at least in the near term, I expect there to be a high degree of uncertainty in that market.
Steve Lear, do you have something to add to that?
3 months ago, my wife and I made a decision that we were going to buy someplace that we were going to really try and live out over 10 to 15 years. And we closed on Friday. We got a great mortgage. That was great. But I also feel that I probably overpaid for the condo, taking into consideration what's going on. Everybody hopefully nobody's in a hurry about buying and selling a home. At this point, if somebody turned to me and said, hey, do you think I should buy a home now? I'd say you might need to wait, and more importantly, you need to talk to the realtors that are familiar with the area that you want to buy and really get their input on whether the timing is good now, or is there going to be better opportunities 2, 3, 4 months from now?
Okay, thanks, Steve. Yeah, that sounds like a great thing that people should talk to their individual advisors about. Seth, is there a risk of depression given the number of businesses and industries being affected? Is this similar to 1929?
So I do think the risk is real. I think it's very different. I think it's very different from the situation in 1929. Keep in mind that depression actually lasted about 12 years or more. So it was, again, a really very different situation, different environment, and certainly the way that the Federal Reserve and Congress acted towards that is very different too. And a lot of those issues were also financially related. And so that's really not the case here. So while, yes, I think it's going to feel pretty challenging over the next several months or so, hopefully shorter, I don't think it's going to be, it's not going to have nearly the duration that we experienced in the 20s and 30s.
Okay, thanks, Seth. And we are at just about 1 o'clock, so I am going to cut it off there. Thank you so. Oh, Steve, did you have a thought on that?
I just wanted to commend Seth for his answer. It was kind of wishy-washy, but it wasn't wishy-washy. It was very practical. So I just wanted to extend a thank you. It's a great question, Seth. I thought you answered it very well.
Okay, thank you, Steve. So with that, we are going to wrap up for today. Thank you again, everyone, for attending. If you are joining via computer, when you exit the call, you will be directed to a 4-question survey. So if you have time, we'd really appreciate you filling that out. It will be especially helpful in planning future calls. And have a great rest of the day. Thank you.
Thank you.
Thanks.
Thank you, everyone.
Thank you.